the valuations that we see out there now are just, insane, and they will come down, and you will see a top, and you'll see Nvidia, and you'll see Palantir, and so on. They will, drop a lot. For 50 years, we have not seen these low levels in job creation as we have now in a much, much larger economy. The problem is that the Fed steps in. Again, you have all these economists, and they have one thing that they do, that's overthink. I think it's going to start in no later than Q2. You will start to see banks also having problems, and this is the deflationary part of it.
Henrik Zeberg, author and head macro economist at Swissblock, it is a true pleasure to host you on Palisades Gold Radio today.
Thank you so much for having me on today.
Excellent, Henrik. I'm really excited for our chat today. You've spoken quite frequently about human psychology, bubbles, technology-fueled booms. And of course, in recent times, we've had to content ourselves with AI, artificial intelligence. We've seen productivity gains. We've seen incredibly large capital expenditures from the big players in the space, as well as really large valuations, market valuations on the stock market for these big players. Do you think we might be along similar lines as the 2000 Dotcom Bubble, or might this time be different?
How do we know that, the butler is the murderer? It's because we have indications of it. We didn't see the murder. Why do I say this? Because when you see something like what we saw in 2000 and 2001, we saw these extreme valuations. We saw the whole narrative about this time is new, and just the fact that you also said that this, people saying or thinking that this time is new or different. Well, it's not. So we have an understanding here now that AI is going to change the world, and it will most definitely. Maybe the largest shift that we're ever going to see in humankind, at least as this generation or the next few generations. And then we front run that, and we think that we know where it's heading. So I think we have the largest bubble right now, and we have that because we are thinking that this is going to change the world, and we will be right. But that's not the same as you cannot have an exuberant market, which I think we have right now.
Yeah, well, it's an interesting argument. Of course, when you look at the dot-com bubble, a lot of the predictions investors made back then came true. They just happened 10, 20 years later. And discount rates can then completely destroy valuations, can't they?
Yeah, absolutely, and you're right. I mean, I think you actually see that the expectations that we have to AI is going to be way below than what reality will bring to us in the future. So I think we could discount for even more if we wanted to. The problem is when things are being discounted for a little too fast, and the changes in the world is not happening overnight. So yeah, the players of the outlooks in the early 1990s were good in terms of what the internet could do, and also when we had the dot-com bubble, but it just didn't happen with that kind of speed we all expected. And I think but then again, we can also say that the outcome of what we had with the internet and everything that came along with that have been maybe even more bigger than what people were expecting back in those days. And I think the same will go with the AI situation here. It's going to be much, much bigger and going to develop into something we can't even fathom, maybe the consequences or the whole thing of today. So I think it's going to be quite extraordinary, but that's not the same as saying that we cannot have that on a short time basis. And I think that is what people misunderstand, that everything can go just because you can spell AI, then everything goes with any kind of valuation, and the players that are there today will be the winners. It's probably not going to be like that either. So I think the world will change a lot, but probably after some kind of a reset where we need to bring emotions back to ground again, and we need to see that people actually also understand that there is a need to actually earn money, and there will be a need for some kind of connect into the real life. This is not just about 5 or 6 companies, pushing revenues onto each other.
Yeah, that's a really interesting distinction between a technological advancement versus market valuations. And I would love to talk about how that would play out over the next few years. And I'm sure we'll do that in just a second. But before that, what are you currently seeing in the markets right now, valuation-wise? What's currently being priced in? And when you look under the hood of the economy, what are you seeing, Henrik?
So you'd most definitely see a disconnect between what is the expectation, the financial world of what AI can bring, and everything else, also crypto potentially, or at least it was that earlier on. and the real world. And I think that everybody if you suggest that you could have a slowdown in this environment, people say, but that's because you don't understand AI and the productivity gains that it's going to bring. And then you can justify any kind of valuation. I don't know, 200, 300 times earnings, and that can still be, a good valuation level. That's ridiculous, obviously. And so I think we are in this phase where there is the fog of the new innovation that comes out, and when it comes out, people will be expecting the moon, and probably will even shoot to the stars. But there will need to be a proper landing first of all these expectations, and I think that's what we see. So the valuations that we see out there now are just insane, and they will come down, and you will see a top, and you'll see Nvidia, and you'll see Palantir, and so on. They will drop a lot also before they find a bottom. Do I think they're bust? No, I don't. Just like Cisco wasn't after 2000 and 2001. Also, we saw a large decline after that Eiffel Tower kind of move that it made. But that doesn't mean that everything is not as bad around it, or these businesses are not doing well. It just means that the hype that has been around this is something that drives things to extremes, and we can't even imagine how high they can go. In my TED talk, I talk about this, the tulip bubble, where we saw that one tulip bulb actually had the price of a house. I mean, and today we say, yeah, but today it's different. And we've looked at Bitcoin, which has a price of $125,000 for something, which can actually also be divided into smaller pieces through ETFs and so on. So people always have an idea, a chit chat or a narrative to support with this. The thing is, we need to see the real life approach and use of these technologies, and that will happen, and it will be the largest productivity gains we have seen in maybe ever.
I think what you're outlining there, Henrik, is exactly why being bearish on AI is so hard, because a lot of the companies that you outlined, Nvidia, Palantir, just to name a few, they are doing incredibly well. They're growing very quickly. They are profitable, which of course is different than what you saw for a lot of the large players in the Dotcom bubble.
Oh yeah, absolutely. But you also have bubbles before where you had big businesses that were profitable. So that just because they make money, that doesn't allow them to have, or it doesn't justify the kind of valuations that we have seen on, for instance, Palantir. So that is true. It is not just a pure air, but they're seen many times in history where you had real live businesses that actually make good money and were just put into on a pedestal that they simply couldn't live up to in the longer time frame. So I think that what we see with some of these, I'm not an expert in any of these businesses, but I think when valuation comes to as frothy as they are, then there will be a decline, and maybe even a crash, and people's expectations to this is going to change. So yeah, there are differences obviously, and it's not the exact same, but there's also the whole market that is being pulled up with some of these performers and a lot of other businesses that also have extreme valuations. So it is and that's why we need to look at it on a general basis at the market capitalization to GDP and say, well, we are at extreme levels today. So, and these levels could not be justified in 2007, 2000 and also in 1929. So probably it cannot be justified today as well. So I think we will see that reckoning, and it will play out over a couple of years, and then you will see that there will be some, maybe even businesses we don't understand and know today, and they can be the winners of this. I mean, it wasn't, what was it, Pets.com or whatever it was called back then in the 2000 that were the winners. They were the businesses like Google and Amazon and so on that were not that big back then. So I think you will have these small embryonic businesses out there that right now are just getting themselves established, and then you'll start to see them grow, and it'll be nice to find the next Amazon, obviously.
Today's episode of Palisades Gold Radio is proudly brought to you by our parent company, Palisades, Goldcorp, Canada's leading junior resource investment vehicle, trading on the Toronto Venture Exchange under ticker symbol PALI, with equity and warrant positions in over 200 companies, ownership of mineral projects and royalties, and a significant stake in newfound gold. Palisades offers investors powerful, leveraged exposure to precious metals, uranium, copper, and other critical minerals. Palisade shareholders directly benefit from our team's extensive industry knowledge and access to deal flow, opportunities historically reserved for a small group of investors. To learn more, visit us at palisade.ca and join us in our mission to level the playing field for investors. Now, back to the show. You started referencing, or at least painting a picture for how anomalous this time frame is that we're actually find ourselves in if you use market capitalization compared to GDP. Could you help us illustrate how anomalous the times are that we actually find ourselves in on a valuation basis?
Yeah, sure. So a lot of people look at the price earning P's or price earnings levels and say what is the valuation of the company versus the earnings level. And when we look at that, well, that's comparable to what we have seen in major tops. I haven't checked it out here recently, but they're quite stretched, I would call them, and especially if you go into businesses like a Palantir and so on. But then you can also just do it on a more general basis and then say what is the general valuation of the stock market and the broader stock market, and then compare it to GDP. And you can say well, it could rise over time, but today we're probably at, haven't checked it the last few weeks here, but 230% or something like that in terms of market capitalization to GDP. And if you look back to 2000 and year 2000, we had the Dotcom, which we laughed about afterwards and saying, well, why were we so crazy and thinking all these valuations would hold? And that was at 130 or something like that, 137 or something. So that was a crazy bubble. 2007 was at 107 to 109 on that ratio. So 230 today is pretty frothy. And when you've had these easy money going on for such a long time, you will have the valuation comes up because the suppression of yields and interest rates have simply made everything that can just spell something with technology has been able to rise. So I think we are, and it's in extremes here, and it's really down to now the real economy, if that can carry on with supporting a stock market like this. And I think that is where I'm surprised to see that the real economy receives so little attention these days, because we're actually having an economy that is in a free fall, as I see it. It's a free fall these days. And yet we are talking about the next funny, interesting things coming out of certain companies. We should look at the consumer that is actually, by the end of the day, will have to buy some of these products and be the backstopping of all of this, because the cash flow comes from one place, and that's from the consumer by the end of the day. So that's the situation, and I think that is why we will see a very large crash in some of these. Not straight from here. I think we have one more go in at least some of the large ones, but some of them may already have topped, and I could see Palantir and Nvidia actually have topped at this point, at least Palantir.
You mentioned that you believe that the economy might be in free fall already due to the strength of the consumer. Why is that?
Not due to this, due to the weakness of the consumer, actually, because if you look to the consumer today, actually, you'll see that the consumer is 70% of the GDP. So when you have a strong GDP, you have for the United States, yes. So we look to the United States because that's where the largest, that's where everything goes on still in the financial markets. So if you look at that, 69 to 70% for the GDP, the GDP growth is consumer and consumption, private consumption. And if you look to that, you will see actually that 50% of that comes from top 10, but 50% comes from 90% of the population of the consumers. 10% from 50, and then 90% takes out the other 50. That is, you can say the top 10 is probably not there where we have seen the problems just yet, but the 90% of you can even call it bottom, because when it's 90%, but below the 90, the top 10%, you will see that there is actually a lot of problems. And you'll see that the unemployment rate has not been moving up just yet, but we are now starting to see job cuts actually moving up. And if you start to look at this on a moving average, and you see to the non-farm payrolls, job creation, and so on, also the ADP numbers, they are now below the levels for all recessions, going all the way back, for the start of all recessions, going all the way back to the 1970s. So for 50 years, we have not seen these low levels in job creation as we have now in a much, much larger economy and much larger workforce than we have now. So we are in a we just saw the open jobs actually here just plummeted the other day. So now we have 1 million less jobs openings than we have people unemployed there in the U.S. So there is a problem, and it's accelerating, and it's a wonder to me why the Fed hasn't discovered this yet. It really is strange. So the economy is struggling, and you will see that is a self-propelling kind of force, because when people are struggling, then they will spend less. When they spend less, the economy will struggle more, and so on and so forth, and people will start to be laid off. We need to see some spikes in the initial claims and in the layoffs, but I forecast that they come here within the next 3 months.
And what are you seeing for leverage in the system? Oftentimes we hear that credit card debt delinquencies are important metrics to look at, for trying to time the cycle. What are you seeing on that front?
Yeah, so you have seen certain of these, some of these have been starting to move up, and you can see that especially, for the customer segments that maybe are the most challenged. You can see that they are actually facing some troubles there. But we also could have a situation where a lot of this, the problems that we normally see there, can actually be located somewhere else these days. And that can be in the whole private, or in the shadow banking system, the private debt, where we could see that there could be other lenders that can become, start to have problems with the businesses that they have set up and starting to lend money to people, ordinary people. So if you start to see that, then it will not be something we can just see in the credit cards. It can be, or the banks for that matter. It can be somewhere else, and that is probably also where we are a little blind here. But there are some delinquencies starting to move higher on the credit cards and elsewhere also, but not to the degree where we say this is normally the recessionary level. That can come pretty quickly when people lose their jobs, and that's the problem.
All right, well understood. And when we try to put these different metrics together, what picture does it paint for you currently? And are there any historical parallels you can draw from to try to, look forward and see what next steps might be in this cycle?
Yeah, I think we should look to a 2001, 2007, 8 combined, because this time around you have a bubble which is larger than in 2001. You have a housing market that is at least as bad as in 2008. You have a consumer that is worse off than in going into 2007 and 2008, and also into 1929, because the amount of people living paycheck to paycheck is actually much bigger than going into 2008, for instance. That was around 35%. That time it's around 65% today. So it's much, much worse today in the real economy. And we have a complete disconnect between the financial world and the real economy, which we did not have to the same degree in 2008, where we had a problem with the housing market, which we also have today, because the house prices, the housing affordability is terrible. And if people start to lose their jobs, there will be an avalanche of people who need to sell their homes, which they can't do. So you need yields to go down. That part is more 2008. But the stock market bubble that we are in is 2001 kind of material. So now we have the perfect combination there. And that's also why I said it's going to be bad, because when both of these unfold, you have the speculation in the crypto market, you have this with the housing market, and also the top in AI here, or the AI bubble as I see it. And all these things are going to be a really bad cocktail. And then you can combine that with some, extreme levels of debt nationally and also privately. So we have all the good stuff in that cocktail, which can start to unfold.
Yeah, I was meaning to ask you, of course, oftentimes what we discuss here on this channel is government debt as they interact with gold closely. They're at levels that, we saw at the end of World War II globally. How does that interact with what you're seeing for the consumer and the economy under the hood?
Yeah, well, so first of all, it's scary to see that they are this high, the debt levels that, as you said rightly, that we have the levels that we saw after the Second World War, and so that's scary, because right now if we enter recession with these levels here, it ties the hands of the governments much more. So when you are Japan, for instance, I mean, if you have a 250% debt to GDP or whatever it is today, then it ties your hands, and it's tied in terms of what you can do to stimulate it, also the economy. So So I think, and also the same goes with the US. We were in 2008, we had a level there at around 60% debt to GDP. Now we see it around 120 or something like that. So it is a problem, and it's a problem where that, we've now done this and we are still in this fix, so to speak, where we have all these problems. And what is going to be then the consequence when we go even further, where we probably normally would see that the debt levels even go up? Well, we start to see that this can escalate into something inflationary, and I think it most likely will. And I think we will not see inflation straight out and right from here. Actually, I think you will see the contrary. But going down the line, 3, 4, 5, 10 years, you're going to have much more inflation in the system, because this whole thing here with these debt levels needs to be simply eroded, and that erosion comes through the inflation we're going to see. So we are going to see a lot more inflation in the system, and it speaks volume in terms of what about fix we are in actually.
With gold trading at new all-time highs, gold producers are printing money. And this means that for the first time in years, money is beginning to flow into exploration. This is a trend that we at Palisades Goldcorp have long anticipated, which is why we spent the last decade assembling the largest junior-held mineral claim package in the United States through our subsidiary Made in America Goldcorp. Made in America Goldcorp holds over 700 square kilometers of prospective ground, located exclusively within America's most prolific gold mining trend, the Battle Mountain Eureka trend. Made in America's properties are nestled amongst several of Nevada's largest gold mines and resources, making it highly prospective for a potential discovery. To find out more, visit palisades.ca and join us on our mission to make Nevada's next multi-million ounce gold discovery. Now, back to the show. Yeah. And if I understand correctly, your thesis is that we might have a couple of good months ahead of us, but after that we'll see a substantial crash in the stock market. The government has shown that it is very much willing to be the buyer of last resort, step in with helicopter money and print any weakness in the economy away. So should one even expect a significant nominal pullback before the government steps in, prints more currency, while we might have real pullbacks, maybe not in nominal terms?
Yeah, I when you say the government, I think you mean the Fed also, right? And I think the Fed will try to step in again. If there is any kind of pullback in the economy at some point, they will step in. There's no doubt. But the situation is that is the problem. The problem is that the Fed steps in, because and the problem is they can't also not step in. So that we are in a fix, because if the Fed steps in with this at this point here, where we clearly have a new inflationary regime, where we have inflation expectations has been moving up, and people actually now remember inflation. I mean, before 2020 or 22, actually, nobody really understood and remembered inflation. It was like a thing of the past, and we now, we don't need to think so much about that anymore. We can just print money. See, the problem is that is not over and done. That is something that shifts, and we have seen these inflationary shifts over time. So now we are in a clearly new inflationary regime, which means that inflation will not go straight up. That's what people take in as a mistaken here point here. It will go up and down, and you will then see, but the trend will be higher, just like we have seen the trend since 1982 has been down on inflation. So I think we will see that the Fed will try to come in and try to stimulate when we see this crash. Yes, there will be a crash, and the crash will come from when the stock market will top out. Don't think we're right here, and as you said, a few more months down the road. Especially because I think the Fed is going to step in and try to do something now when this weakness in the labor market, which I think is so obvious, is going to dawn on them, and then they will pump the market one more time. They did that in 2008 until May. It was only a bounce back then. I think it's going to be an all-time high this time, but eventually it will crash. And then when they step in for real, and when I say for real, that's not just by lowering rates. That's like, new QE, new something, which when they stare deflation right in the eyes there, I think you're going to see that the inflation will come out instead. And that's because simply the system here now is so soaked with liquidity that we have already harvested all the benefits of printing money, or putting more money into the system. That we have done since 2008, and this has now lasted 18 years, and and since QE in 2008, and then we'll see what happens next, because we are starting to see that progression in Japan already. We see in Japan that they thought they had killed inflation forever, and all of a sudden, guess what? Inflation is going up. They started 10, 15 years before we saw that in the US. Actually, they started during the Asian crisis in 1997, really, and so they started 10 years before. 10 years down now the road here, I think we can be at the same place if this continues. But I think the reckoning actually can be much further before, and it will be when the Fed comes in next time here, that we will not see the same kind of activity starting to evolve. The thing is with QE is meant as we lower rates by QEing, then suppressing rates. And when we do that, you and I will then say, oh, then we can save some money on our mortgage loan, and we can go out and we can spend that money. When we spend that money, we'll have some more people to work, and that will have a positive effect. Problem is, if we are already soaked up to here, or we remember inflation, which we do because we remember that we had high rates. Also, this is still happening. Then our psychology shifts, and that's where QE actually becomes impotent, because you can't make people spend the money. So even if you and I, save, 100 euros per month, we will think, okay, do I want to spend this, or do I actually want to sit on it and wait to see? Because, I don't want to run out and spend it because my dad or my husband or whatever just lost his job, and we need to make sure we got this. Also, if inflation has been running higher and the price level has been going higher, so people might not have the same tendency to spend the money that they save. And that is the problem, because then quantitative easing, monetary policies becomes less effective. And then you can have a slower phase where the economy actually does not bottom out. It may have higher unemployment for longer, and you will start to see prices coming up, because you will then have the effect of people saying, oh, yeah, we need to actually put our money somewhere, and especially the financial market then start to run into commodities and gold and silver and whatever. So I think there will be a whole new situation we haven't seen before. It will be a shift that is due to this monetary shift, or the inflationary shift we have had in the regimes after 2020.
Henrik, wouldn't one, if we were to go into the scenario that you're outlining here, if there's high inflation, be incentivized to spend the money rather than sit on it like you outlined in that scenario?
Yeah, sure. At that point we will, and then it will then trigger even more inflation. Yeah, sure. At that point you will. But
so you're predicting first deflation, then inflation.
Yeah.
Is that correct?
The situation is what I'm talking about is here in the first phase, so when the Fed comes in and say, oh, we got your back, we'll make sure. But you're right. The moment when the inflation starts to run, that's a different perspective. Then you'll have the incentive to start spending that money, and things will run faster. Price levels will go up, and so on, and we'll start to erode away some of the debt. That is a thing, but they need, and they will do that. We will see that we have these negative rates, real rates, where inflation simply is running higher than the nominal yield level or rate levels, and that will be a thing, because that's the only way they can erode some of this debt away. So yeah, but you're right on the question.
So then, once we go into that inflationary spiral, perhaps one could call it, should one expect a cracker boom-like scenario where everything is going higher in price, including asset prices?
Yeah, that is the thing, actually, But again, we have to understand that we are now looking at the long time frame. I mean, we're talking about a journey here that starts here today, and then we're talking about something that could be 2, 3, 5 years down the road. I actually do expect and think that real estate, land, commodities, and so on, real hard assets will significantly appreciate in value take over the next 5 to 10 years. I mean, like a lot. And we have seen gold and silver actually front running some of this, which I do think will come down again. But I think you're going to see a lot of that in the next many years here, because that's part of the new inflationary cycle that we have. The problem is the journey until that point. I mean, that point will be a new phase for us, but the transition from where we are, where you actually have this environment we have right now, and then until the moment we stand there with the new inflationary regime going, is where I can see it can be a little difficult. And that will probably go through a phase where the economy needs to stagnate for a little longer before it starts to run, and then it'll run too fast, so to speak, which is what inflation really is about. So I think you'll see that there will be a phase where it stagnates and the economy not really getting started, and QE is not going to help. It's only going to bring inflation, and then all of a sudden it starts to help. But yes, to your question again, hard asset at down the road is going to be the one for the next many years ahead here.
Yeah, that could be an incredibly painful scenario that you're outlining here. What assets should one think about to potentially get out on the other side of the scenario that you're outlining here? Perhaps potentially even better or the same as they are now?
So I think it'll be difficult in the initial phase here. So you see now, for instance, people say, "Oh yeah, but some might think the stock market's top here." If they then start to run up higher, which I think they could, then you'll see that people will start to jump onto that wagon and say, "Okay, now Henrik will be wrong. There's no recession. The Fed will save our day, and we'll see markets go higher." Only to see then there's the market top. And then actually it'll be good to be in bonds for some time, because when the market drops and yield starts to drop, which they will do initially, then you will see that bonds will be good. But then when the Fed steps in and you start that inflationary cycle, then I think gold and silver and commodities and what else have you, real estate and so on, will be a fantastic investment over the next many years. So it is this about saying jumping into something now and just holding on to it is I think it will be very difficult because it's not the same phase we have today as we will have like in 6 months, like we will have in 2 years.
So you think it's very much about timing the cycle correctly and being in the right asset at the right time?
I think it'll be very much about that. People say that it's just about staying in the stock market. I don't think it's like that. I can't remember, was it BlackRock's CEO who said something like that? You just need to stay in the stock market. No, you definitely do not. If it's going to drop by 50, 60%, which it easily can. Gold and silver has taken off before. I saw it to a very large degree, but I still think right now, right here, you don't want to own it because you're now starting to see that deflationary period setting in, where inflation is heading lower, and you're going to see potentially also a need for liquidity going in. So that is also not. So you need to sort of, if you want to optimize it, then it's probably. Then there will be some difficulties in doing that and trying to navigate that kind of these waters. But if you look down the road and say, I don't need to do anything about any of this, I just leave it aside and it's money I don't need to touch, well, then every hard asset you can get your hand on today. But just understand that every hard asset can also have a 30% drop or 40 or 50% drop. But 5 years down the road, I would imagine you'll be much better off.
Awesome. I would love to dive into your long-term outlook, that 5-year time look for hard assets in just a second, but perhaps we can talk about indicators first. If you want to time this cycle that you're outlining here, what indicators can one trust to potentially gauge where the economy is within this larger playing field?
So I really don't understand why people find it so difficult to gauge where the business cycle is. You just look to the job market, but that's where, again, you have all these economists, and they have one thing that they do, that's overthink. And you have 200 PhDs or 400 PhDs at the Fed, and they didn't see the financial crisis coming. The slowdown we have right now is so obvious that it's hard. I mean, it's hard to not see it. I mean, I really do not understand how people cannot see it. If you look to non-farm payrolls and you look to ADP numbers, you look to job cuts and so on, as I said, you will see now that there is a significant slowdown. And it's actually, as I said, it is getting to the point where it's worse than we've seen so many years back. This is just an indicator. Just look to that. The economy cannot create value unless people go to work. It'll say, yeah, but it's because of AI and nobody needs to go to work. No, that's not how it works. You need people to work. So that's it, because then they will not spend. I mean, AI will not spend for you, and the consumption is 70%. So you cannot have AI to do this. You need people. People need to have a job so they can go spend. If they don't, well, then you'll see the economy running backwards. So look to that. Look to the short end of the yield curve, and just say, well, what is happening to short-term yields here? Are we seeing a significant strong drop? If that happens, then probably we're getting closer to that top. They are hanging in there, but I can see that they could drop very soon and very, very strongly. And you can look to a lot of these what I call the imminent recession indicators that are starting to move, but not really moving yet. And that's why I'm not calling the recession just now. I'm saying the move is in that direction. So, but that would be to look for that. It will also be about, fighting the emotions in us. I mean, right now, today, and maybe also the next week here, it'll be difficult for people to see that, well, we could have a strong market rally, and I still believe we're going to have that. But if the market goes up 20% from here, for instance, then you will be sucked into it, because any money manager will have to say, well, I can't sit and look at this. I need to be part of it. And anybody with some money on the bank account will say, well, I need to buy, stocks here. And then they'll do it. So, it's also about controlling your own emotions going into this and understanding that maybe I don't need to be part of that, because right now we are so exuberant already. And that's what, great analysts or great investors do. And Buffett has been out, and Berkshire Hathaway has been out. But now they bought some Google, and they did that well, but only for a very small portion of their fund. But they are very much in bonds right now, and also in cash. So it's really not about trying to time it and doing, as a pro and hitting exactly the tops, because I think very few people will be able to do that.
Yeah, isn't Berkshire Hathaway, Warren Buffett's company, like 25-30% cash if you look at their net investable assets?
Yeah, I haven't checked it over the last, but I think it's probably the largest relative cash position that they've ever had. I think it's even over 30 at this point here. Yes, so that's rather large, and I think they're also starting to buy some hard assets, and they bought some. There was a lot of talk about they bought some Google shares, but obviously, if you have that kind of cash, you can't just let it stand and see Google moving up in a straight line as it done over the last 6 months, 9 months. So I think they have done rather well, but they have a very large cash position.
Yeah, I would love to talk about hard assets for a second and your longer term outlook, because I understand one should expect a lot of volatility, potentially a 50% drawdown in the short term within your framework. But when you look at the current trends for gold, how do you currently see it, and how does it fit within your framework?
When you look to the business cycle, inflation is a lagging indicator. Why is that important? Because we see always when we go into the final phase where that inflation is keep staying higher. We saw that in 2008, where it actually topped all the way into 2008. Inflation was not the first thing to roll over. It was the leading and the coincident indicators. If you 2001, it was the same, and so on and so forth. It's the same thing every time. And you always have a spike in commodities and and also sometimes in precious metals going into a recession. What you can say this time, in 2008, it was oil. Oil had a fantastic spike. It went up to 150, I think, or $140 per barrel back then. We've never been anywhere close to that since. So the thing is, that was the whole talk about China and emerging markets back then, which brought that up. And we said, well, it's because they're going to take over the world. There'll be a fantastic need and demand for oil, and that's why it will go up. Boom. That happens into that kind of phase, the final phase. This time, it has been another kind of story. It's been the story about de-dollarization, which is not happening. It's about debasement, which is where we say, well, debasement, that is because of inflation, but inflation is actually on its way down, and it hasn't. We had a spike into 9.1, but then it came down to 2.3 to 2.5, whatever it is, and then it's actually seeming like it's plummeting. It seems like it's plummeting right now, and if so there's no debasement, right? You can't really talk about that. You can talk about it might come. But I think that is what you saw with gold and silver, and it actually front run the whole situation, which we're going to see down the road quite a lot. And you can see that if you compare it to the inflation expectations, and the inflation expectations, they shot up higher back in 2025 here, early 25, but inflation never went there. And so it was really about people expecting inflation to come, which is a normal dynamics of a late phase economy that we are in right now. So I think what you saw there with gold and silver, there's absolutely something about that we are going to see, a complete change of the monetary system at some point and so on. But this was again being front run to a degree where people it was pure speculation. I mean, silver at 100, I don't even know, what did it hit, 125 or something like that on the silver per ounce, dollars per ounce, obviously, dollars per ounce, for a product that is mostly used in industrial, in industrial production. So I think it was beginning with a narrative which will be developing at some point, but then it just exploded, and nobody could, anybody who says that this is something they predicted, well, predicted based on what they're going to see down the road. And then they should also be able to say, well, but the pullback that we could see now, and I think is happening already. If you look to silver, it has a technical bullish engulfing or bearish engulfing, candle on the weekly from a few weeks back. I think you're going to see a large decline in gold and silver here, and but that will probably be the time to really buy it when we see that bottom and people are really running away from it again, because things are going to change in that inflationary world that I spoke of, and I think this has been the first move, but we always have a strong pullback, and that pullback will definitely be worth buying.
Completely understand your argument of that a large part of the move that we've seen in gold and silver is forward-looking, predicting inflation and therefore speculation. One could also argue that de-dollarization is behind it. I mean, 25% of gold buying the last few years, when you look globally, it has been central banks, specifically in the East, buying up gold reserves. It has recently surpassed US treasuries as a holding for central banks. Seems like that potentially could be a driver that continues for quite a while. So does that distort the image that you're outlining here as purely a debasement trade?
First of all, I think it's a hype trade, first of all. Debasement trade and a de-dollarization trade also, as I said. But there's a difference between what is really going on. And if you look to the foreign reserves, which is held in US dollars, it did not decline like that. It's a 57, around just below 60% of foreign reserves are still held in US dollars. That is not really what we should see in de-dollarization. If de-dollarization was happening, we should see it declining to 50, 40, and so on. It does not. And I did see there was something going on around on X, but it seemed very wrong because I checked the numbers with IMF and they don't seem right. So you really see that people were talking about this. And also, if you look at simply the different assets that the foreign governments in the European Union are holding these days, they have not started to sell out of their US assets. So these assets are still very much in the US in dollars, and I think you're going to see quite the opposite over the next time here, or the next coming weeks and months here, that the dollar is starting to strengthen again, and that whole narrative again. There's a narrative, and then there is a reality, and I cannot see the debasement. I cannot see the de-dollarization. But if you talk about that, there's going to be a reckoning one day when the whole debt thing is going to collapse. I completely see that, but that will be an inflationary environment. Right now, we have an inflation that is heading lower. Look to the work of Trueflation, you can see how strongly that is actually developing at this point. So I don't think people are jumping onto that wagon and starting to talk about it much more than it's really happening, because the facts are not supporting de-dollarization or debasement to this degree. It was a talked about thing, and now I think the reckoning comes for the precious metal for a little while here.
All right, so on a potential pullback on the precious metals, it might be an interesting place to actually add as a hedge.
Yeah, sure. I mean, any decline here at this point. I mean, first of all, I wouldn't buy at these levels here right now. I would see the meaningful pullback, and I would see a meaningful full pullback into a recession. We have a recession coming. If a recession is coming and the dollar is going to go to the levels I expect, I think the dollar can go to 120 on the Dixie. You don't want to hold precious metals at this point. You hold whatever you have in your storage and say this is, but you don't want to buy it. So you will see that there will be this meaningful pullback, which will be larger than most people think, but will be a good thing, because I think it will be something then for people to pick up when the sentiment is different. I mean, you don't want to do it when people are running around and talking about de-dollarization and debasement or whatever. You want to talk about when people are saying gold and silver didn't have that anyway and now it's dead. Then you pick them up, right? And I think that is where the narrative sometimes can be giving away what it is that we actually see.
Well understood. I would love to ask you if you could shortly outline on what timeline you think this recession thesis could play out.
When will it be recognized? That's one thing. So first, if we go back to 2008, it was recognized by the NBER in December 2008, I think it was, and it set off in December 2007. So 1 year later, it got recognized. I think it's going to start in no later than Q2. I will say that now, no later than Q2, but probably in March, will be March or April at this point. And I say that based on the latest developments we have in the job numbers or in the labor market, and we will see the Fed do something about it. I think, Yeah, Q2 probably. I think you'll see that there. There are so many similarities to what happened back in the late 2007 at this point here, also with the spike in 10-year, 3-month yield spreads and so on. If you look to those things, you'll see that we are in that kind of environment there as well at this point, and people are in disbelief we are in this twilight zone where people think the economy might be strong, and now we don't have inflation any longer, and what then? And the Fed will be before we get to the top, we will also see that there will be a sentiment that people think that the Fed is going to save us. So I think there are some months still to go, but March could be the earliest, and then I think the latest could be into what could be May. Let's say May then. And so this is how early and how long it can be. I think the deflationary phase of this, and there we should think like what happened in 2008 March until October. And what you really saw there was that you had a bounce in the market until May of 2008, but there was an underlying deterioration of the economy, it just progressed. And there was a lot of loss of jobs in that period. And you saw that a lot of value were starting to erode simply. And that all of a sudden led to first Bear Stearns, and you had that was March actually, and then I think you had then you had Lehman Brothers in September. And although a lot of other banks started to have problems. Banks get problem when the consumer gets into trouble. So when you see a rather large decline in the employment or unemployment moves up, you will start to see banks also having problems. And this is the deflationary part of it. Then at some point the Fed will come in, as I said earlier, and they'll do something for real. And I think before we get there, that at least we'll see 6 to 9 months. So say recession starts in May, and we then have 6 to 9 months before the Fed steps in. That brings us into early 27, and then you can see the stagflationary phase start from after that. So that was as close as I can get. I'd probably be wrong, but as I said, I'm not too worried about giving these outlines because I'm not basing everything on this. I'm basing it on what I see in the market, and I will change my mind tomorrow if the data changes. But this is pretty much as I see it in terms of a timeline.
Yeah, we of course spoke about indicators earlier. So if the indicators were to flash red later, you would just move all these timelines 2-3 months later.
Yeah, sure. I mean, if things are not developing, I mean, like what we've seen with the job market has at this point is already very, very weak. And I was expecting that in 25, and I expected it to happen faster. And then people say, but you're changing the goalpost. And basically, of course I am. I mean, I'm not stupid. I'm not sticking onto something that is obviously wrong. So if you're saying, what is your best outline for this? The direction is clear. There's no doubt about that. But when it's going to happen is going to be the variable in this, obviously. I mean, so if things change, I will change my mind. But it's not like I'm changing direction and then say, okay, now we're just heading up. Again, unlike a lot of people, I've not called for a recession to start at any point. I've said we're heading towards what is going to be a severe recession. And I will say, when I say it is here now, we're getting closer. We're very close at this point, which means we're in 26 and probably Q1 or Q2. And then we'll see if things change, and if I see, for instance, initial claims stay low for longer, and we see the job cuts starts to decline again, and what else do we have? Well, of course, then I'll have to change, but that's not what we see right now. We see it actually rising.
I appreciate that, Henrik. What is the number one step someone at home can take to prepare for the scenario that you're outlining?
Yeah, I think it's about understanding that these days of double-digit growth in your portfolio, if you were in crypto per day or whatever it is going to be over. I think that the greed. I think we'll have one again. I want to say I think there's one more phase, because I think the Fed will come in like in 2008 in January and come in and send markets off, and it will bring a sentiment out there. But I think there will be a period after that where we'll have to understand that this about crypto and whatever, and also gold and silver shooting up like that, and you have these extreme moves, is not going to be the name of the game for the future. So people need to understand that actually just having a portfolio that develops more slowly in the future will be more of the future for them, and they will have to think out that the digital world will become less important, and not because it's less important in real life, but the whole speak and narrative of crypto and all that is going to transform into where the focus will be more on real assets in the future. So prepare for that. I mean, maybe wait with the big investment in your house until you're through this, and then buy a new house, or invest in some gold when we get down that road, or silver or whatever. But understand there'll be some fluctuations here, and then don't let the greed and FOMO take over.
All right, perfect. Can you talk to us about Swissblock for a second?
Yeah, sure. So Swissblock is a private wealth manager, and we have been focusing. We're born out of the crypto market, you can say, and there are some great tools there. We have a great Bitcoin trader, you can call it. We call it Hawkeye, which really has been outperforming Bitcoin. So that's quite amazing and fantastic, and actually getting our clients out in due time before tops and bottoms. We also have a macro department, you can say, which is what I head, and the focus on that is simply to ensure that our clients understand the outlooks of the economy and the market, and not do that out from traditional banking understanding of that the market one day and the economy in one day can be in a fantastic state, and then all of a sudden somebody says something and then you'll be in a decline or you'll have a recession. That the economy actually goes through a business cycle which is quite identifiable, and that is what I do. So we have that, and we are also looking into other areas of business which will be developed over the next few years. So it's a quite exciting group that I'm together with.
Perfect. Thank you so much, Henrik, for your time and insights today. Really, really appreciate it.
Thank you so much.
This podcast is for general information purposes only and does not constitute investment advice, an offer, or solicitation to buy or sell any securities. The views expressed are those of the host and guest and do not necessarily reflect the views of the company or their affiliates. Guests on the show are not compensated for their appearance. Certain discussions may include forward-looking statements subject to known and unknown risks and uncertainties that could cause actual results to differ materially. Listeners should do their own research, consult a licensed financial advisor, and not base any investment decisions solely on the information discussed. For a full disclaimer, please visit our website, and for full disclosure and risk factors of any companies referenced, please see full available disclosure and risk factors on their CEDAR Plus at www.cedarplus.ca.